Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys.empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
So welcome everyone to another very unique episode of our Physician Empowerment webinar and podcast. And we just came back from a very exciting week in Mexico, in Cancun, where we talk about Health and Wealth Summit, where we talk about literally health and wealth, every aspect of it. And we had a grand time. So today we're going to invite an old friend back, Galen Nuttall. And Galen has been with us for a few years. It was actually one of our very early physician empowerment events in Toronto, right? That was a very, very well-attended event. And Galen's a very interesting individual. So Galen, you speak what, 4 languages, lived in 3-4 countries, you have 3 passports, you have a Master of Education degree, and now you're dealing with, you become a podcaster, and then you have a well-subscribed podcast with physicians and business, incorporated business professionals. Right. So tell us a bit about your journey. Like, how come you evolved so much?
Yeah, for sure. No, thanks for having me on. I'm really happy to be back. It's been a little bit since I was on the podcast, but yeah, no, I mean, my journey, I really kind of fell into the industry. My wife and I, so I lived, like you said, Canada's the 4th country I've lived in, moved here about 13 years ago. I'm here for good now. But my wife and I moved here 13 years ago. My background was in education. I have a master's in education, taught grade 5 and adult education, but I also had a math background. My undergrad, I double majored. One of my majors was math. And basically I was looking for a career change. There weren't a lot of teaching jobs to be found in 2010 in Ontario, and my wife hated her job, so I couldn't be a stay-at-home dad forever. I needed to make some money so she could quit her job. And my own financial advisor asked me if I'd be interested in thinking about the career, and I initially was not interested at all. I really had no clue as to what it was going to be like, and I didn't want to be the kind of person like cornering people at parties trying to get them to talk about finance. I didn't want to do any of that stuff. So it took me about 8 months to decide whether I was going to go for it or not, and that was 13 years ago now. No, 12 years ago now.
Wow.
And it's been a great 12 years for sure.
So how do you get linked up with so many physicians? What's your linkage?
Well, the first thing is, so my dad's a physician. He's now retired. He's a nephrologist. And really, when I started off in the career, I kind of looked around and I was like, how am I going to look any different than the other? I think there's something like 80,000 financial advisors or insurance people or bank people in Canada. And I was like, how am I going to look any different than any of them? And so one of the things, I'm bilingual, but I'm bilingual in Spanish, which isn't always all that helpful in Canada.
It was very helpful if you went to Mexico.
Yeah, exactly.
Or Southern US.
Or United States, yeah, exactly. So, I had friends who were like, Galen, leave Canada, come to America. You're fluent. You could get a job anywhere you want, being fluent English, Spanish, bilingual. Anyways, but so I talked to my own father about, kind of his own journey with finances and how he wished he'd had someone there to really give him good advice all along. And so I thought, okay, maybe if I work with physicians. And then the next step was basically I just talked to the first physician I knew. I'd known him for a long time, and I became an advisor. I said, do you mind if we just sit down and we talk about what I do? And yeah, we eventually did a great plan and investments and insurance and everything. And so the other thing that I realized along that journey was, I was supposed to be mentored by someone else who hired me. We went to this physician's house. We did like a discovery meeting. We walked out and he said to me, I'm way in over my head. I've never met with a doctor before. I don't really know how corporations work. And I was just blown away. Like, why didn't we find someone else to come with me? So I quickly found out that I think it's gotten better, but not a lot of advisors or financial planners a bit more, but advisors in general don't maybe understand corporations very well. And so I decided to get really familiar with the medicine professional corporation, the ins and outs and all, but what does it look like to make the most of a corporate structure? And not just for physicians, but business owners also, but typically physicians. And then then I started a podcast for physicians, a Facebook group for physicians, YouTube channel, and all those things. And that's really just kind of put my nose to the grindstone and just focused on that group of people. And now that I've worked with many, many physicians, there's really not much I haven't already seen in the physician landscape of how people are using their corporations or questions they might have. So it's just made my life, I'd say, a bit easier rather than trying to work with absolutely everyone out there, but focusing on people that I thought could make a difference in their lives.
Yeah, we definitely, as physicians, well, as me being a physician myself, we're definitely a specific blend of professionals and business owners, right? Most of us are incorporated, and there's something unique, but there's something not that unique, right? We're more similar than different compared to, let's say, dentists, podiatrists, physiotherapists, whatnot, right? Whoever is incorporated, or just business people, right? But there's something unique, and something unique. And that's why we formed Physician Empowerment, is we found that a lot of us, we're super busy. We don't have time. We don't have brain space. And we have a bit of an ego problem. We don't want to admit that we don't know, right? We don't want to appear stupid. So that's why this is a safe space. And this year, our focus is to go back to the basics, right? Back to the basics of financial freedom. And step number one is to understand the terminologies, what they mean. And I'm going to say that insurance is a very sensitive word. For some people, it's a swear word. It's very divisive, it's polarizing, right? In different sectors and even amongst financial advisors. So let's dig deep into that. So today we talk about the what, why, who, when, how, right? So let's just start with the why. Why do we need insurance other than when we're dead, right? Let's think that's it as a protection, right? People say, I don't have kids, I don't even need insurance. So can you quickly just broad brush why everybody needs insurance?
Yeah, no. So, I mean, that's a really good way to start. And I mean, I can give a very quick anecdote of my own experience. So, I became an advisor at the age of 33 or something like that. I owned zero insurance. My own advisor had tried to get me to see the value of owning it. I had a wife who didn't like her job, a big mortgage, two small kids. And he's like, Galen, you need life insurance. And I was like, nah, I don't think so. I was like, if something happens to me, like maybe my family will help out. Maybe this will happen. I don't know what else. So when I got my license, one of the things they did as part of our training was we watched a video, and the video was about a woman who unfortunately had been widowed, had a husband about the same age as me, same dynamic, young family, and he unfortunately had been killed in a car accident with a drunk driver. And part of the video, she talked about how the one thing she didn't have to worry about was money, because he had some really robust life insurance. And she even started a foundation around education around drunk driving in his name. And I watched that video. So I traveled a couple hours from where I live. I live in Eastern Ontario, and I traveled to Ottawa. It was a 2.5, 3 hour drive. And I was coming home for the weekend. It was Friday afternoon, and they had showed us this video. And I went down to my car and I put my key in the ignition, and I was about to drive like 3 hours back home on the 401. And I went to turn the key, and I literally couldn't turn the key because I thought, if something happens to me on this highway, my family is absolutely financially devastated, in the sense of my wife's never going to be able to quit her job. She's probably going to have to sell the house.
Right.
I don't know how much my parents really want to help. Like, I mean, they probably weren't counting on having to come up with a whole bunch of money to support my family. So I literally took the key back out of the ignition, went upstairs. It was Friday afternoon at 4 o'clock. And I was like, guys, I need to buy some life insurance before I drive home. And I found the maximum amount back then that you could get, like, on the spot, was $500,000. And they said, Galen, as long as you've got a check that you can write for this, like, I was, I'm healthy, so there weren't, medical issues. And I said, as long as you have a check, you can write a check, this will be in place until we like finalize the contract. And I never carry checks, but I looked at my wallet and had one check. And I've never been so careful about how I write a check in my life. Wrote the check, handed it to them. They gave me the temporary insurance agreement. And I drove home, like, honestly, like I was floating, because I just felt like if anything were to happen to me, the last thing I'd be worried about is whether my family's going to be okay financially. Now, since then, I've gotten a lot more insurance than that. And I mean, one of the things we can also clarify is, after I finish the anecdote, is, I mean, we're talking about multiple different kinds of insurance, but that was like my first like real experience with insurance, was when it just kind of hit me, like someone who looked exactly like me in the same stage of life I was, had taken care of his family and didn't have to worry about it. And then I thought, wow, I'm really not taking care of my family. So it took me a while, but I got on a mission to make sure we were covered in every possible way after the fact, because,
Right. So let me share my story, right? So this is 31 years ago, 31, 32 years ago, where I just started my practice. And of course, you get nothing but debt, right? You finish your residency, and I bought a practice with money that I haven't got. And anyways, we got nothing but debt, right? And then here we go, right? This financial advisor said, you need that, you need this, and you need that. We just got married, we had no kids. And then there's like all the insurance. At that time, the premium was so high, right? Appeared to us so high. And my wife actually had a B.Ed degree, and she also had finance diploma. She was actually a financial planner for a short time as well. So I relate. And then so we're reading some of these books, and they were saying that, well, this is dovetail to the next topic, what to buy, right? And they said, hey, you only need term life, right? Buy the cheapest term life, right? And then get the cheapest, and then disability, wow, just get a high amount so the future you can enjoy it. And 30 some years ago, $5,000 a month was a lot of money. So that's what I bought. Right? I thought I couldn't fathom $5,000 a month. Wow, that's a lot of money. Just finished residency, right? Of disability income. I was young, invincible, right? 120 hours a week. That's how long we pull, right? Like per week, right? And I cut down to 100 hours per week once I started my practice. I gave myself a 20-hour a week work cut, and off we went. And then so fast forward 28 years. 27 years, right?
Mhm.
I found myself in the hospital. I have infective endocarditis. I ended with open heart surgery.
Oh man.
And that's just around when COVID just started, as soon as I finished my open heart surgery. And of course, I became uninsurable.
Mm.
And when I was trying to access my disability insurance, OMG, the $5,000 a month can't even pay my overhead.
Mm.
Right? And then to test drive the process, how to get that money, how many days do you need to be, like sick? And it was just super stressful on top of fighting the recovery, right? Stress for the wife, for the kids, right? So this is the awakening story, right? Awakening story. So not to mention there are others. So let's go to the what kind of insurance? Like, there's always this argument, term versus whole. Yeah. Can you give us a really brief overview?
Yeah, no, I mean that's quite the story you've got there of someone actually like because disability insurance is a very important one. And yeah, that's quite the story you had there. I was not aware of that background you have with insurance.
Mm.
Yeah, so I mean, like you said, really when we talk about insurance, like so one of my favorite quotes about insurance is from a financial planner out of the States named Nick Murray, and he said, "We insure against what can go wrong in order to acquire the luxury to invest for what can go right." And so when I talk about financial planning, a lot of times I talk about financial planning is like a tree. So I sit down with people, I found out what their goals are. Like, okay, what are the future goals that almost everyone's worried about retirement. So retirement's almost always on the table. If they have small kids, they're worried about their kids' education. Maybe they want to buy a cottage. Like there's different goals. And I think of these goals as leaves on the branches of the tree of the financial plan.
Mhm.
And the way to get to those leaves is we water the tree with savings and smart investing, tax efficient investing. That's how the tree grows, right?
Mhm.
Now, just like a real tree in the real world, a financial plan needs strong roots. And so like a tree can look very robust and great, but if it doesn't have strong roots, it's going to get blown over in a storm. And just like a financial plan can get blown over in a storm. So if someone has a lot of savings, but they're not protected against what can go wrong if they get hurt, if they get sick, or if they pass away, then that plan can be completely demolished. Just like my own case, if I had passed away on that car ride home, my wife never would have been able to quit a job she hates. Kids
Mhm.
probably wouldn't have been able to go to school, would have had to sell the house. I mean, like, we had a pretty good looking tree. We had a nice big house and everything. But if I couldn't bring in an income, if I were gone and I didn't have insurance, it would have all fallen apart. So when it comes to what types of insurance, I mean, one more thing I'll say is you talk about insurance being polarizing. And it can be. I mean, there's kind of like a continuum. Like there's some stuff that I think is fairly well acknowledged that it makes sense. Like a lot of people would agree, okay, term insurance is a good thing for people to have. Disability insurance is a good thing for people to have. So there's kind of like a continuum of there's pure protection, which is things like term insurance and term disability. And then there's things on the other end of the spectrum that are a combination, like whole life insurance or disability insurance that has like a return of premium rider on it, where you get some money back if you don't get hurt. Critical illness, where you can do a split dollar arrangement, where you can actually get money out of your corporation tax free. So there's a real continuum there of like super simple, this is only about protection, like term life insurance, and then something that's a bit more complex, like whole life insurance. So the place where I start with clients or with anyone I'm doing a plan for is I ask them, what if something had happened to you yesterday along the lines of getting hurt, sick, or passing away, would you have a income issue today? And like, would someone in your life that you care about be impacted financially? And what would that look like? And so in my own example, if someone had asked me that question 13 years ago, I would have said, well, I've got 2 young kids. I want to make sure they go to school. I want to replace my income until they're, out on their own. I want to get my mortgage paid off if I were to pass away. And then basically what I do is we paint the picture of what someone wants to have happen when the undesirable happens. Like in your case, the disability insurance, like how much money would you need coming in every month to keep things going if you couldn't earn an income? And then I look at, okay, great. This is what you would want to have happen. What would actually happen? And is there a gap? And if there's a gap, then we look at what's it going to cost to fill that gap, whether it's disability, critical illness, term life, or whole life insurance.
Now, to be honest, the past me, I didn't know. Right? At that time, I was broke, right? We're in debt.
Yeah.
That, gee, the premium is so high. I can't afford it. Of course, we could, right? But we couldn't because we thought there's so many other things we need to do, paying off the debt, buying a house, paying off, right? Like there's so many things. So how do people stomach that, right? Lots of people in that stage, and the ticket gets high, and so they get the smallest ticket, which is what I bought.
Yeah, it's a good question. So, I mean, so most of the physicians I meet, so we'll just talk about disability insurance for a second, because disability insurance can come across as expensive, but it's also, I'd say, the most commonly accepted insurance I find. Like almost every physician I meet either knows they need disability insurance or they already have it, and they got it in like med school or residency. Like someone bought them a lunch, they signed a piece of paper, they got disability insurance, right? And now, I mean, one of the things about disability insurance is you can structure it such that it's more affordable in the early years, covering what you need, and then you can actually lock in the ability to increase it over time. And one of the ways I look at disability insurance is simply what's the percentage of income we're using to protect the whole income or the rest of the income. Disability insurance policy on an annual basis, it's usually a couple $1,000s, but what are we protecting against? We might be protecting against 6 figures of income that could disappear if someone gets sick. So what's that percentage there? Like we're talking about, taking 2, 3, 4% of one's income to protect a whole bunch of the 80% of the rest of the income kind of thing. And the other thing with disability insurance is, I mean, sometimes people like the idea of getting the return of premium, or if they don't claim, if they don't get hurt and they don't take any payments, every 8 years they get half their money back. That's pretty popular for people to just kind of feel like, oh, I'm not just, I'm going to see this money one way or another. I have it on my own disability insurance. I got a check like a year ago. That was really fun because I'd been putting away the money. And I mean, obviously every situation is different. I mean, the other analogy I use with insurance and why it can be polarizing is I think of any financial product or approach that someone has is kind of like a toolbox. So like, okay, I've got this toolbox and I'm using these tools to build my future financial reality. So everyone's toolbox might have different things in it. Some people might have real estate. Some people might have corporately held investments. Some people might have TFSA, RSP, Bitcoin. I mean, whatever. Like they might have all sorts of stuff in that toolbox. But what's important is that people get the tools that work for them. And I think one of the reasons it can get polarizing is because people can sometimes, so there's tools in my toolbox. Like I have a very specific tool. I had to put in a drop ceiling in my house a few years ago, and I had to put in these special drill bits into the ceiling. It was really difficult. It was a lot of work. And then I found out that they sell a drill bit specifically for this very specific screw that needs a little hook on the end to be able to put the drop ceiling on it. And I bought this drill bit and it just saved me hours and hours and hours of work. And anytime I need to adjust that drop ceiling, I just go back with that drill bit and it's super easy. Now, if someone borrowed my toolbox and they were going to go build a fence, they might open up my toolbox and say, Galen's an idiot. Like, why did he buy this bit? It has nothing to do with building a fence. And it's like, well, because I wasn't building a fence. I was putting in a drop ceiling. So I think that can happen in the insurance world too, where people have created their own plan. They have their own toolbox. And then they hear about someone buying a tool that they don't personally either don't feel like they need, either don't need it or they don't feel like they need it. And they see other people buy it and they kind of say, oh, you shouldn't have bought that because that tool doesn't make sense.
Yeah, totally. No, that's a really good analogy. Okay, so let's just spend a minute, go back to life insurance because it becomes a tax planning tool. In a couple of weeks, you're going to do a deep dive with our masterclass students that how this is part of advanced planning. And this is where it gets really polarizing. Right, can you just give us a bird's eye view how insurance policies can be used as a tax planning tool and a wealth building tool?
Yeah, for sure. So there's 3 big places for physicians. So I'm going to, most physicians have corporations, like we've said, not everyone, but most of them. So most of the physicians I work with have a corporation. And the 3 places a physician is going to get taxed is money coming into the corporation. It's going to get taxed at a corporate level. money that's inside of the corporation growing like an investment will oftentimes get taxed as well. So you're going to get taxed on the growth, maybe you get taxed on the distributions. So that's the second place where people get taxed. And then the third place is when they take the money out to use it personally, right? Because I can't use my corporation to buy a cottage. I can't use my corporation to like feed my family. I have to take that money out and use it personally. So three layers of tax, right? Corporate going into the corporation, money growing inside of the corporation, and then money coming out of the corporation. Now, where whole life insurance can help is with 2 and 3, money growing inside of the corporation and money coming out of the corporation. So whole life insurance, the Coles notes are it's a type of insurance that provides a death benefit, but it also has a cash value that grows as an investment at the same time. And it is not under the same rules as traditional investments. Like if someone buys a GIC and puts it in their corporation, it's going to get taxed. All that growth is going to get taxed. If someone puts their money in dividend bearing stuff, it's going to get taxed. And I'm not saying these are bad things. I'm just saying it's the reality of a corporation holding an investment is it can be a very inefficient place to hold investments if someone's not careful. So life insurance is under a different tax treaty. So basically that money is allowed to grow and not taxed as it grows. And there's different ways of accessing it. And I'm not going to pretend there isn't some level of sophistication to understand this, but we're going to go into a deeper dive at some other point. But basically the cash value that's available there, you can either leave it as a long time death benefit. So like when I meet people and they're really interested in legacy, that's part of the plan, is what's an efficient way to leave everything behind to my kids or loved ones as a legacy. And if they want to access it, they can borrow against it. They can borrow out of the corporation in a way that's tax efficient. They can leave money behind in a way that's tax efficient. So the important thing to know, I mean, I'll say one thing is, and I'll talk a little bit more about this, but the reason why it's so polarizing is also because a lot of times people don't design it the right way. It's really important how to design these policies because they can be designed lots of different ways. So the criticism of policies that I see out there is usually based on what I call an old way of designing them. Some people will still design them this quote unquote old way, as I term it, which makes it less attractive than if people design it the new way. But yeah, at the end of the day, the way it can be a tax efficient way of growing wealth is using corporate dollars, putting it into an investment that will not be taxed as it grows and can either be left behind in a tax efficient manner or accessed in a tax efficient manner.
Right. In fact, in my journey, I found that actually even from my patients and friends who are wealthy, they actually have ginormous policies, right? And in fact, I think the tax codes and CRA saying that thou shall not go beyond this amount of life insurance. So that means they give you, it's a huge tax shelter, right? If you overinsure, then you get penalized, but there's a big, thick blanket of tax shelter there. So let's leave it at that because that's not the emphasis of this overview. Then who should we insure for, right? And so again, a little bit of personal story, right? So as soon as I found out I'm not insurable, then I got to make sure that my family needs to be insured, right? And in fact, we found that, hey, as soon as I found I can leverage the policy and have policy loan, right? My wife and I started to top up our insurance, whatever we could, and we still are. And to buy insurance plans for our kids. And we told our kids, they were just in teenage, and say, kids, mom and dad are buying you life insurance. So that it's a gift for you. So you'll never be rejected ever in your life like your dad.
Yeah.
Plus, we instantly leverage the money out, right? So it's just such a good thing. So it's still who, right, is actually our whole family now. So can you expand a little bit on that? Who will benefit and all that?
Yeah, absolutely. So, I mean, so when I said that analogy of the tree, I think of, let's say the parent generation, like my wife and I, as an example. We have our own tree that we're growing and building towards. Like retirement is a big one. We're both self-employed. We've got no pensions. We're on the hook for everything. So retirement is a big one. Then I think of our kids as having their own trees. They have their own little trees. Now, and what I hear from a lot of clients around what they want to make sure they pass on to their children, or at least are striving to, is good financial management. Like not spending everything you make, not going into unnecessary debt. All those things are huge life lessons that people try to impart to their children. And above and beyond that are financial products. So, and I mean, everything I'm saying are exactly the things I did for my own kids, which was like you're saying. So, my own children have their own life insurance policies, they have their own critical illness policies. And I did these because, just like you said, I mean, the younger someone is, the healthier they are typically, the cheaper the premiums are. It can feel like something crazy. Like if I went out there and asked 1,000 Canadians, like, do your kids have life insurance and or critical illness insurance? I'm not sure how many people would say they do. Like a life insurance, it used to be pretty common once upon a time. Like I meet people in their 70s and 80s, and they're like, "Oh, I have this policy that my parents bought for me when I was like 3, 4 years old." I don't think that's as common as it used to be. And critical illness,
Oh, I haven't heard one.
yeah, and I think critical illness would be even less common, to be honest. But I bought it for my kids because, just like you said, I want to lock. So first off, if something happens to them, God forbid, like anyone who's listening who has a child, it's the last thing I ever want to think about. But if it were to happen, God forbid, I would be an absolute wreck for I don't know how long. And so, like, I don't know what would happen to my business. I don't know what would happen to my income. I don't know how much time I'd need to take off, if anything happened to my kids. And I mean, I do have an example. My daughter ended up in the hospital for 5 days a couple years ago. Thankfully, it ended up being nothing serious, but I didn't work for those 5 days. Like I couldn't think straight. I was in the hospital. My wife and I were taking turns. We were getting takeout. We had to pay for babysitters to watch our other child. We had to pay for parking at the hospital, which is super expensive where I live. So, I mean, my wife and I did the math, and not even accounting for lost business, like the time that we weren't working,
Mm.
a 4-day hospital stay for my daughter cost us $1,200. Not even in medicine or anything like that. It was just
Oh,
like we had to find someone to take care of our son. We got a ton of takeout. We had to pay for parking. We had to we just ended up spending all this money because we had zero time because we were so focused on our daughter's well-being. So
yeah.
critical illness, just in case anyone is unaware, it's a insurance that pays out if someone gets diagnosed with a critical illness like heart attack, stroke, and cancer. And
Hmm.
so, in the case of my children, they have enough such that if anything happened to them, I'd be able to take off a year or two of work just to focus on them if I had to, and if the situation required, and potentially pay for treatment if I needed to travel somewhere where I needed to pay for a treatment for them. I'm gonna do it. Like if I have to go to some other country to pay for a special treatment they need, which is that's not necessarily the first thing people think of, but it has crossed my mind where sometimes you have to go to places to get special treatment.
Well, another angle is any other financial planning or investment vehicle, they look at your net worth, right? But life insurance, they look at your health score, right? So by the time we bought our kids insurance, they were just teenagers. Well, but one just gymnast just fractured an ankle. The other one had asthma. Third one has something. Gee, it's not even clean yet, right? Already, right? They're just
Yeah.
teenagers, right? And people who needed to get these elaborate plans, they're 60s, 70s, and of course the premiums just skyrocketing, right? So I wish earlier I had that insight while we were healthy, right? We invest in that. Okay, so that's the who, and we touched a little bit about when. So would you say in the landscape, right, in professional, brand new students, residents going on and different stages of career till retirement. So when is a good time, when it's not a good time? Like how much should we pay attention to the timing of insurance?
Yeah, very good question. So, I mean, it's a really good question. I mean, like I've said, everyone's toolbox is going to look a little bit different. But when I meet people, the earliest I typically meet people is residency, sometimes med school, but residency is a little bit more when people reach out to me. And I rarely tell them they need a full financial plan because that's one of the things I offer is full financial planning. A resident, I'd say almost never. Like, wait until you're in practice, wait until you've got some finances under your belt. But what I do say to them is in the meantime, we should be making some really good decisions around insurance because that's something that it is a little bit more critical from a time perspective.
Right.
So like most med school students or residents I meet, like I said, they either have disability insurance or they know they need it. And I agree with that wholeheartedly because basically it's the most valuable asset that someone at that age has is their ability to earn income. And so locking that in, and like I said, there's ways to design it such that it's not as expensive in the early years. You can ramp up the coverage as the need ramps up. Companies are very good at structuring it in a way that's flexible. So that's very important. Life insurance, again, there isn't always a need at the moment for life insurance, right? If I meet a resident who's unmarried, doesn't have a house yet, maybe they have some debt, but they're not really worried about it. And they say, Galen, do I really need life insurance? I just paint a picture of like, how much do you think you might need in 5 years? Are you planning on getting married? Do you think you're going to have kids? Do you think you're going to have a mortgage? This is how much it's going to cost to lock in what you're potentially going to need. And does it make sense to do it or not? So it can make sense for them to buy life insurance as well, to be able, like you've said, to be able to lock in the ability to have it in the future. And then as far as whole life insurance goes, I don't really oftentimes see it make sense until people are a little bit more mature in their practice. They've got a good sense of cash flow, how much is coming into the corporation, how much is being held behind. We've got a good sense of their long-term goals. Then whole life insurance makes sense. And then, sorry, the one I skipped over was critical illness insurance. For me, it kind of goes hand in hand with disability insurance. It's something that's going to pay out when someone isn't earning an income or needs extra money to take care of medical issues. So yeah, it's kind of like, a lot of these things can be structured in such a way that they kind of grow with the individual. Like I was saying, the return of premium disability insurance, if someone feels like that's too expensive to start, they can add it later, or they can, I always look at the contracts that the companies issue to make sure that, to know exactly what they can do with it. And even term insurance can be converted to whole life insurance later. Critical illness can be converted to the return of premium kind. It can be moved into the corporation if someone wants to. So really, I have physicians now who are well into practice who started with me when they were in residency. And we basically just always had this idea of an organic insurance plan that was going to grow with them and also adapt to their needs.
So what about in the second phase of our life, right? Like the practice is mature 10, 15, 20 years now. We're thinking about retirement, intergenerational wealth in sight, far away, 1 to 3 decades away, right? So then from just pure risk mitigation to now a wealth planning tool. So what would you advise to the mid-career physicians and on? Should they top it? Do they add something? Like what's your advice broadly?
Yeah, it's a good question. So, when I think about the last, 5 or 6 physicians I've worked with in their 40s, there's a bit of a continuum there, right? Like some people are they've got kids in rep hockey, they've got kids like horseback riding, like there's just a lot going on in their lives that makes it such they don't have a ton of money left over at the end of the day. They're the ones who are like, Galen, just get me to retirement, show me how to do that. So that's part of the plan, is like, if a lot of the times when I do a plan for someone, we find out how they can get to retirement, and then we see, okay, is there extra money behind? What do we want to do with that extra money? What does it make sense to do? So to talk about the whole life thing, sometimes I meet physicians in their 40s who have excess money above and beyond what they're going to need to retire. Like, we've done the math, they're going to be able to retire. This is excess money. And then we say, okay, one of the questions is, do you care about intergenerational wealth? We've been talking about that a bit. Some people, they don't care that much. Like, I did a plan for a physician who's 60, about to turn 60. And he said, Galen, you know what? My kids are taken care of. I get that I'm going to pay some taxes when I pass away. So be it. And I showed him, like, I'm still going to show him, like, I haven't finished this plan yet, but I'm still going to show him, like, this is what you can do. This is how much taxes the government's going to take. This is what you could do to help offset that. Do you want to do it or do you not want to do it? That's kind of my approach to things. And some people say, you know what? I really don't care. I'm just going to pass away and let the government take what it's going to take. And other people say, no, I want to leave a legacy, whether it's children, church, charity, and sometimes other family. Like, I've got a physician who doesn't have kids yet, but she is helping her family financially, parents, brothers, sisters. I know a family, they have special needs. So they're like, Galen, we need a lot of money to make sure that our child is taken care of,
right?
Because they're the special needs. So those are some of the, individual things that might make it more sense for someone to consider whole life insurance.
Yeah.
But yeah, for a mid-career physician, that's part of what I look at is, are you going to be okay in retirement? Do we have extra money? Should we be putting that into whole life? Or from the portfolio you have, does it make sense to carve out some of it to put into this very specific type of investment?
Right. Now we're stepping into a last topic, right? And it gets spicier, and controversial. So this is the how, right? Do we put it under the corporate name, under the individual name? You really talk about some corporately owned life insurance policies, right? And as a tax planning tool, wealth planning tool. So how do we navigate about this how? Like, first of all, how do we think this through? Should we do it personally versus corporately, PC or holdco? Like, what's the way that we should think? Guide us down the thinking pathway.
Yeah, no, that's a really good question. And there's probably no shortage of opinions on this sort of thing. But to make it very simple, typically I tell people, do not like disability insurance, personally held. Because if a corporation owns a disability insurance policy and someone gets disabled, that money lands in the corporation and they still need to get it out of the corporation. So I'm a big I mean, I've heard other people say different things, but that's my experience is let's keep the disability personal. Term insurance, it can kind of go either way. A corporation can hold term insurance. You're using corporate dollars to pay for it. Money lands inside of the corporation. So you still have to kind of like navigate that a bit, but it kind of depends on the individual. I have some people who hold one term policy in the corporation, one in the personal. Like the personal one is the one that they know they can get at really quickly if something happens, the corporate one a little bit longer. Critical illness, like I said, it's usually personally held, but if someone's doing split dollar critical illness, then it should be corporately held, and that's a strategy. Now, whole life insurance almost always makes sense to be held by a corporation because an individual is using corporate dollars rather than personal dollars to pay for it. And whole life insurance, there's a calculation depending on how long you've owned it as to how much comes out of the corporation tax-free, but it makes more sense from a net benefit standpoint for corporate dollars to pay for it than personal dollars. And there's that asset growing inside of the corporation that's tax advantaged. Now, you mentioned holdco. If someone, not every physician has a holdco, some just have the medicine professional corporation. So it kind of depends. Like if someone owns real estate, usually they'll open up a holdco to kind of move that into the holdco. Or if they have like tons of money in the MPC, they'll move it into a holding company. You don't necessarily have to. It's a very individual sort of conversation to have. But if someone already has a holdco, I tell them to put the life insurance inside of the holdco because I like to separate it. And I'm not, if anyone out there is listening and they haven't done that, I'm not saying it's a bad thing, but it usually makes sense just to, if you already have it, just to put it over there. I don't know if I'd necessarily tell someone to open a holdco just to hold life insurance, but if they already have one, it's like, why not make the most of that structure? And then, like I said, it's a bit of an advanced topic. It's not suitable for everyone, but if it's corporately held, you can actually borrow against the policy and get the money in a way that bypasses the personal tax side of the corporation that someone would normally have to pay that personal taxes coming out. Right. So that's another reason that it makes sense for the corporation to hold it.
And there's a lot there, right? So this is like a chapter one, the content page of the book, right? Like just trying to highlight future topics. Definitely, Galen, you'll be invited back and we'll dive. And actually 2 weeks from now, we're going to do the masterclass, right, as insurance-based tax planning, right? There's a lot there. And we'll dive into those, a few strategies that are very contentious, right? And people have holdco, opco, all those things. We'll discuss that. But we'll leave it at that. And I'll just conclude this episode with what you said as the toolbox, right? In real people, there's a actual physical tool. In medicine, there's a crash card. When people code, right? And each drug is life-saving, but if you use it wrongly, you kill somebody, right? So some of these are very potent strategies. Given wrong, you be dead, right? The life insurance doesn't apply to you, or there are bad consequences. Or you do it wrongly until everybody said that you should do this, until you get audited by CRA and kaboom, right? Disaster happens, right? So it has to be part and parcel of a very clear-cut game plan, right? So we're not here to offer any personal advice. That's this disclaimer, right? We do all the time. We're here to empower you, our listeners, to ask smarter questions, right? For your own unique plan. And you need somebody who would hash out that 360 plan that we talk about, right? It's a complete roadmap, right? Just like a family physician, everybody needs a physical, right? At your physical, talk about the whole goal, stage appropriate diagnosis, diagnostic tools, and screening tools, whatnot. So thank you, Galen, for spending some time with us. Welcome everybody to come back, listen to future episodes, and to join us at the masterclass where we'll do deep dive into these topics. Thank you, Galen.
Yeah, thank you so much for having me. This is fantastic.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phys-empowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phys-empowerment.ca. Thank you again for listening. Bye.